Welcome to our latest Kanawha video. Today I'm going to discuss some investment tax strategies. It may seem to some investors that nothing can be done to reduce investment-related taxes. What many people don't realize is that there are several tools available for reducing the tax liability generated by investments. If your financial advisor has certified financial planners on their team, these are some of the tools that they should be considering to reduce your taxes. To drive home the importance of this topic, consider the impact of tax drag on an investment portfolio. We define tax drag as the percentage of investment return that an investor is not getting because of the taxes that their portfolio generates. As this graphic shows, a 2% tax drag on an initial investment of $500,000 can lead to a portfolio that is over $600,000 smaller after 20 years. This will be somewhat of a crash course in these tax strategies. Each of these topics warrants its own deep dive. I should also point out that we are not CPAs and that any tax advice should be confirmed with your tax advisor. The first tool that I'd like to cover is tax loss harvesting. No one likes to see their investments lose value, but there can be a silver lining when they do. Realized capital losses can be used to reduce taxable income by up to $3,000 per year. They can also be used to offset capital gains elsewhere in your taxable estate. Also, any capital losses that you don't use in the current year can be carried forward indefinitely until they are used up. There are some important considerations around tax loss harvesting. First, this tactic only works in taxable accounts. Neither realized gains nor losses matter for taxes when we're talking about retirement accounts like an IRA. Additionally, you may want to retain market exposure in case the investment rebounds after you sell it. But you have to be aware of the IRS's 30-day wash sale rule. If you buy the same investment within 30 days of selling it, then any loss that you may have realized will have been negated. For this reason, an investor may choose to buy an investment that they expect will roughly track the sold investment's performance for 30 days. For example, you could sell stock in Pepsi and buy stock in Coca-Cola. The second tool for reducing taxes is your charitable giving strategy. Many people believe that they're getting a tax benefit when they give to charity, but that's not always the case. Since the 2017 Tax Cuts and Jobs Act was passed, which doubled the standard deduction and limited certain itemized deductions, the number of filers who get a tax benefit from a direct cash gift fell from 31% to 11%. Making tax-effective charitable gifts can be complicated, but for most people, the solution boils down to either giving cash directly, giving investments with a low basis, or if an investor is of an age to take their required minimum distribution, to make what's called a qualified charitable distribution, known as a QCD, directly from their IRA to their desired charity. Again, this topic deserves its own dedicated video, but this flowchart gives you an idea of the nuances involved. Now on to number 3, Roth Conversions. This is the act of converting some or all of the assets that you hold in a traditional IRA over into a Roth IRA. This can be beneficial because withdrawals from a traditional IRA are taxed at your ordinary income rate, whereas Roth IRA withdrawals are tax-free. If an investor believes that he or she will eventually have required distributions from their IRA that far exceed their income needs, converting money to a Roth can lower their eventual RMDs and thus save taxes in the long run. A little bit of a warning though, Roth conversions are not appropriate for everyone. Analyzing whether it makes sense for you will not only require the collaboration of your financial advisor and CPA, but it will also involve forecasts and assumptions about future returns and tax brackets. Having said that, anyone who is concerned about their RMD creating big annual tax bombs in their retirement years should look closely at this option, especially if they expect to experience low income years between when they retire and when they begin receiving Social Security. Our fourth tool for reducing investment-related taxes is the strategic location of stocks and bonds in certain types of investment accounts. Long-term stocks generate tax liabilities by creating capital gains and qualified dividends. These tax events are taxed at an investor's capital gains rate, which is lower than their ordinary income rate. By contrast, bonds generate interest payments that are taxed at a higher ordinary income rate. So what does this mean for you? All things equal, you'll incur less taxes if your stocks are in taxable accounts and your bonds are in retirement accounts, in which the income is not taxed. As with everything I'm discussing today, your specific circumstances and existing portfolio may not allow for this strategy, but it can be very effective when it's appropriate. Lastly, consider whether a municipal bond is appropriate for you. Interest paid by bonds that are issued by states and municipalities are generally federal tax-free and can therefore sometimes create a bigger tax equivalent yield than something like a corporate bond on which the interest is taxable. But be careful. Your specific tax bracket will influence whether or not a municipal bond makes sense for you. As we're illustrating in this example here, wherein an investor in the 37% federal bracket gets a superior yield with a municipal bond, while the investor in the 22% bracket is better off just staying with a corporate bond. That concludes today's discussion. To reiterate, we recommend that you consult with your financial advisor and potentially a CPA before implementing any of these strategies yourself. Don't let the complexity of this topic stop you from acting. It's your legal right to pay as little tax as possible, and doing so is a matter of knowing the right tools. Thank you very much.